This is John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, March 15. To view our full range of publications, visit our website at www.investingdaily.com. Well, stocks hit new highs last week as optimism over economic growth continued to fuel the post-election rally. An encouraging inflation report and a break from the recent climb in interest rates also drove the market's record gains last week. The U.S. Bureau of Labor Statistics reported last Wednesday that the Consumer Price Index, the CPI, increased only 0.4% in February, in line with consensus expectations. The CPI over the past 12 months gained only 1.7% year over year, also meeting estimates and falling below the Federal Reserve's standard target of 2%. Enactment of President Biden's $1.9 trillion American Rescue Plan, as well as his generally well-received primetime address to the nation last Friday, also cheered Wall Street. U.S. and global equities closed the week higher, and they're also in positive territory year to date. The following table gives you a snapshot of the week's action in the U.S. and global markets. Take a look. As the number of coronavirus infections and deaths decline and states reopen their economies, we're witnessing a rotation from growth to value and from large caps to small caps. Market rotation is when money stays in the stock market but moves from one style, sector, asset class, or other attribute to another. Certain sectors of the economy typically outperform or underperform the broader market, depending on the stage of the economic cycle. Right now, you should bet on economically sensitive stocks that will prosper during the economy's reopening. As economic growth accelerates this year, sectors that should outperform include energy, financials, industrials, and consumer discretionary. The recent rise of smaller equities strengthens the bullish case by conveying greater breadth to the rally and reflecting optimism over the economy. Over the past 3 months, the Russell 2000 has climbed 23.07% versus 7.53% for the S&P 500. Take a look at chart number 2. There's a comfort to investing in large-cap companies with familiar names and products, but the right small-cap stock can lead to outsized portfolio gains. Mega-cap stocks offer a margin of safety at a cost. Meaningful earnings growth is harder to come by for the companies at the top of the food chain. It's more difficult for them to move the needle. But for small fry, an acquisition or organic expansion can turbocharge earnings and produce big gains for shareholders. President Biden last Thursday signed his $1.9 trillion stimulus package into law. The plan contains a range of measures, including $59 billion worth of assistance to small companies. The bill also contains an additional round of direct payments to most Americans, amounting to more than $400 billion. The following infographic provides details. How should you divvy up your portfolio? As a general rule of thumb, don't allocate more than 5% to any single sector and avoid placing more than 20% of your portfolio dedicated to sectors. You can use between 1 and 4 sectors with 5% allocated to each. So, to reiterate, as stimulus kicks in and the economy reopens, you should emphasize value, economically sensitive sectors, and smaller capitalizations. For details, consult my article that accompanies this video on the Investing Daily website. Well, that should do it for today. If you have any questions or comments, send your emails to mailbag@investingdaily.com. In the meantime, stay invested and please stay safe.